September 15, 2008. A 158-year-old titan of global finance breathes its last. In less than 24 hours, $600 billion simply evaporates. Retirement accounts vanished. Career paths incinerated. The global economy flatlining on the operating table.
But what if I told you this wasn't an accident? What if the greatest collapse in human history didn't start in a boardroom, but with a lie so simple you could fit it on a billboard?
Why rent when you can own? That one sentence burned down the world. This is the story of how the American dream was weaponized, packaged into a bomb, and handed to the people who could least afford to hold it.
It's 2002. America is nursing a brutal hangover. The dot-com bubble popped, and 9/11 just sucker punched the national psyche. Wall Street is twitchy, but the Federal Reserve has a plan. Money isn't just cheap, it's practically free. Borrowing becomes the new national pastime, and suddenly the message is everywhere. TV ads, radio spots, neon signs. Congratulations, you're approved. You make $40,000 a year? Here's a $500,000 mortgage. Don't have a job? No problem. No assets? We don't care. Enter the ninja loan. No income, no job. Assets? Zero. Back then, a house wasn't just a roof and four walls. It was a status symbol, a lottery ticket. And the banks? They weren't just lenders anymore. They were dealers. And the whole country was addicted. Traditional lending standards launched out the window. Risk assessments, too boring for the party. The new rule was simple. If you have a pulse, you have a mortgage. We're talking about subprime mortgages. Translation: loans for people with bad credit, unstable income, or just a vague idea of what money even is. Should I be worried about paying this back, you ask? The broker smiles. Not your problem. If you default, we just sell the house for more next month. Prices always go up, right? It was a gold rush. Your neighbor's house doubled in value in 6 months. Baristas with $5 in savings were signing for luxury condos. McDonald's part-timers were suddenly real estate moguls. People bought houses like they were buying ramen noodles. Lenders printed loans like monopoly money. And in the middle of it all, a question lingered like a ghost in the room. What happens if the music stops? By 2005, the rot had set in. But Wall Street had a magic trick. See, they knew these loans were garbage, but they figured if you bundle enough garbage together, nobody will smell the stench. They called them mortgage-backed securities. Imagine a box. Inside that box are thousands of mortgages. Some are good, but most are toxic, the kind that belong to people who can't pay. Wall Street takes this box to a ratings agency and says, label this safe. The agencies, getting paid millions by the very banks they're supposed to watch, shrug and slap a AAA rating on it. That's the highest rating possible. Gold standard. It's like hiring a food critic and telling them they won't get a paycheck unless they call your raw, salmonella-laced chicken a Michelin star masterpiece. But they didn't stop there. They took the leftover scraps of those boxes and blended them into something even more complex. CDOs, collateralized debt obligations. Financial alchemy, turning lead into gold. Except the gold was radioactive. Not everyone was drinking the Kool-Aid. A handful of outsiders, misfits, skeptics, the crazy ones, actually read the fine print. They saw the fraud. They saw the cracks in the Jenga tower. And they asked a question that terrified the status quo. Can we bet against the American dream? Wall Street laughed at them. You want to bet against the housing market? That's adorable. The banks were so arrogant, they built the very weapon that would kill them. They created the credit default swap. It was insurance. You pay a monthly fee, and if the housing market dies, you get $1 billion payout. It was like taking out a life insurance policy on your neighbor's grandma and then rooting for her to fall down the stairs. Wall Street thought it was free money. They didn't realize they were selling the matches to the people who knew the house was made of gasoline. 2007. The first domino falls. A missed payment in Vegas, a foreclosure in Florida, a condo complex in Ohio sits empty. Then the whisper becomes a roar.
Home prices are falling.
For years, the world believed the lie that housing always goes up. But the Jenga tower was built on lies, and someone just pulled the bottom block. Suddenly, those AAA safe investments were revealed for what they were: financial plutonium.
Panic spreads like a virus. Hedge funds bleed. Investment banks slash billions. And then the unthinkable. Lehman Brothers.
An institution that survived the Civil War and the Great Depression collapses. No bailout, no hero, just the $600 billion crater in the middle of Manhattan. The message to the world was terrifying. If Lehman can die, anyone can.
Overnight, the global heart stops beating. Banks stop lending. Credit markets freeze. If you're a business owner and you need a loan to pay your staff, denied. If you're a family looking for a mortgage, rejected. The power cord to the global economy was ripped out of the wall. This wasn't just a number on a screen. This was real life. Retirees watched their 401 kiloseconds, the work of 40 years, evaporate in 40 minutes. 8 million jobs? Gone. 4 million homes? Foreclosed. Families who never missed a payment were evicted. Unemployment offices looked like disaster relief camps. And then the ultimate insult. The U.S. government faced an impossible choice: let the entire world burn or hand $700 billion of your money to the very people who lit the match. They called it TARP, the Troubled Asset Relief Program. The banks were too big to fail. So while families moved into tents, the government brought out the fire hose. They pumped billions into AIG, Goldman Sachs, and Citigroup. The Fed started a money cannon called quantitative easing, printing trillions out of thin air to patch the Titanic with $100 bills. It worked, kind of. The markets stopped falling. The banks unclenched. By 2009, Wall Street was popping champagne. Bonuses were back. But on Main Street, the smoke hadn't cleared. In 2011, the rage boiled over. Thousands gathered in Zuccotti Park under a single banner: "We are the 99%. It wasn't just about the money. It was about the betrayal, the realization that we live in a system of privatized profits and socialized losses. When the banks win, they keep the money. When they lose, you pay for it. No major CEO went to jail. No handcuffs, no perp walks, just golden parachutes and quiet retirements on private islands. The system survived, but the trust, that burned to the ground. A whole generation grew up watching this. They learned that the experts don't know anything, that the safe investments are often the most dangerous, and that the house always wins, even when the house falls down. As we sit here today, the names have changed. The jargon is different, the billboards have new slogans, but the mechanics of greed never change. Because if 2008 taught us anything, it's this: the next crisis won't look like a disaster. It will look like an opportunity. It will look profitable. It will look inevitable.
If you want to keep the adrenaline going and understand the hidden forces that control your money, make sure to hit that subscribe button and turn on the bell. In this world, information is the only real hedge against the next collapse. Don't just watch the system. Learn how to navigate it. Subscribe to stay ahead. We'll see you in the next one.